Well, hello everyone and welcome to today's webinar being brought to us by GreenTraderTax.com. I'm very pleased to have Robert Green, CPA and CEO of GreenTraderTax, as well as Green, Neuschwander, and Manning. So, Robert's here today to talk more about the IRS and tax benefits due to COVID, as well as those quarterly estimated income taxes. So with that, let me go ahead. I'm going to pass the controls over to you, Robert. If you would go ahead and share your desktop, let's get underway here this afternoon.
Thank you, Cynthia. Let me go to full screen here. Okay, hello
Excellent.
everybody, and just 1 second actually. Okay, everyone, glad you came today. Let's talk about, will the IRS deny tax benefits that you were hoping to get as a trader in securities or in commodities with trader tax status? You're hoping to get those, but will they deny those because of special conditions due to COVID? Think about it. So many people have come into trading this past year, and will the IRS grant them, a good portion of them, trader tax status and all the benefits that flow from it? Business expenses, losses, QBI deduction, health insurance, retirement deductions with entities. There's a lot riding on it, and people want to know. And a lot of traders have done great this year. It's pretty amazing. And now they have to worry about quarterly taxes. They didn't pay Q1, Q2, Q3. They didn't know how they would make out at year end. The big Q4 payment is coming up January 15th. Do you pay it all then, or can you pay a bunch of it also on April 15th? So we're going to talk about these conditions that have something to do with COVID. Here's a current photo of me. I'm managing member of Green, Neuschwander, and Manning, our CPA firm, and CEO of GreenTraderTax, the publishing firm. Today's information is educational. Where specific tax advice is necessary or appropriate, you may wish to consult with a qualified tax advisor like me or my partners or our CPAs. We are not affiliated with Interactive Brokers. We're a CPA firm. They're a brokerage firm. We thank them for hosting a lot of our webinars on a monthly basis. We think it's a nice relationship, but it's not affiliation. We added an IRS Circular 230 notice. Pretty much says just what I said. The statements are informational. They're not tax advice. So you're not relying on this to avoid penalties. If you want that, get tax advice in writing from me on a specific one-on-one. I'll field some questions at the end today, but they're kind of general in nature. You want customized answers to your customized questions, and that's where the consultation comes in. So this is a little bit of a pejorative statement, but I couldn't help thinking it gnawed at my gut for a couple of months. COVID traders. Who's a COVID trader? Is it one of the founding fathers, Benjamin Franklin, who couldn't work in Philadelphia anymore, had to work from home and had nothing else to do but maybe consider trading to make a living for his family? Maybe. We didn't, I don't know the history of the markets, but I doubt they weren't like they are now back then. So trading has proliferated during the pandemic. You've all read the stories in the media about some of the trading apps that have popped up and how they've gone from few accounts to dominating to number top rankings within the top rankings of number of accounts. And you have everyone trading from high school kids, college kids, millennials, people in their 30s, 40s, 50s, 60s, 70s, 80s, even 90s. I've never seen anything like it. It reminds me a little bit like the .com in the 90s, but that was, commissions were, $30 or more. There were computers, there weren't apps, there weren't browsers, there weren't scanning softwares, automated trading, trade copying, zero commissions. It's just phenomenal what there is now, and people realize the acceleration of technology and even invest in it. So anyway, a lot of people have come into trading. That's the bottom line. So far in 2020, it's been a highly volatile year. That's what traders like. They want volatility due to significant uncertainty over COVID-19, a shock to the economy, and job losses. Now, as the virus spread in the US, millions of displaced Americans, they turned to trading in financial markets as a means of making a new living. I remember when crypto was all the rage back in 2018. Now it's like options are all the rage. You got the whale helping out with SoftBank, but a lot of people have been playing the options actively, and a lot of them qualify for trader tax status benefits. So some of these new traders, and it's amazing, I do consultations all day, every day. I've never had a year like this where not even a break for a day. And people, it's amazing to me, and I keep using that word, I better change it, how many people started in April, May, June, July, after the initial COVID crash, and they've just been, they think it's easy money. I can tell you it's not easy money. I've been doing this a long time. There are ups and there are downs. Nevertheless, some of these new traders have been active enough to qualify for trader tax status benefits, business deductions, 475, health, retirement, and other related benefits. Now, TTS, trader tax status, has to be regular, frequent, and continuous. So if you come in April, May, and June, and then you stop, that's not continuous. If you're there in April, but not in May, and back in June and not in July, that's not regular. If you're just a couple of days a week, that's not frequent enough. So we lay out our golden rules from GreenTraderTax to give you more of a factors to qualify for. Regular, frequent, and continuous is too vague. Now, here's the big question of the day. Will the IRS deny TTS to COVID traders if they only carry on a trading business during the pandemic for a short time? What is a short time? Are they in during the good times and out during the bad times and get called back to work and stop trading? So I think that that's an extra special issue this year more than prior years, and we're just not sure how the IRS is going to react. Now, if you've been an existing client and trader of ours using TTS for all of last year, 19 and 18, and you have a history as a trader, and you made the decision to elect 475 for the tax loss insurance. If your house burns down, you can get an ordinary loss, an NOL carryback this year, get back a big refund check, tax loss, fire insurance, 475. So I'm not as worried about the existing trader from 2018 who happened to incur a massive trading loss when the COVID crash happened in March, and then the V-shaped recovery in the markets in April. They may have had the big Q1 loss, the correction has stopped trading. So you say, okay, Bob, they only traded for Q1. Why isn't the IRS going to give them a hard time? Well, because they had a history. They were using TTS. They already had 475 where they knew to elect it by July 15. They came to us before April 15th, and then the IRS extended the election deadline to July 15th. So they had the premonition to elect 475 for the tax loss insurance. They saw they had a big loss in Q1. I think they're okay because they're in business. If it's all in 19 and 3 months into 20, that's 15 months. The IRS can't say it's just 3 months. So there, I'm not too worried about it. I'm more worried about the new trader who might not qualify for TTS and others who missed the 475 election. So concerned with the millions of newcomer traders who open online trading accounts offering free or low commissions in 2020. Many of these rookies have significant trading gains year to date after the recent sell-off, even after the recent sell-off. You know, maybe they were up a big chunk and they gave back a little bit, but they're still up a lot. Now, in the trading business, as you probably well know, Gains can turn into losses with a substantial correction in volatility if you start betting the wrong side of the market, or I don't like that term betting, trading the wrong side of the market. So when that happens, traders count on Section 475 for tax loss or fire loss insurance. The new clients that I've had since July 15th, the deadline for electing 475, they don't have it. They don't have it 475. If their house burns down, they're not going to be able to write off those losses because that election was due July 15th. So TTS, trader tax status, is the linchpin that you assess based on facts and circumstances. You put the bread in the oven, you pull it out at year end. Did it rise to be bread? If it did, you claim the TTS. There was no election for TTS, but that only gives you the business expenses. That could be $5, $10, $15, $20,000. That's good, but that's not the tax loss insurance you may be looking for if you have a big loss. And if you happen to have a big loss this year, and maybe it hasn't happened yet, maybe it's going to happen in Q4. Maybe you'll do great in Q4. You just never know with trading. The CARES Act, which is the COVID Act, permits a 5-year NOL carryback refund. So if you have a huge loss in 2020, you can go back 5 years. The House bill wanted to trim the sails on that. They didn't really want that. You remember the Tax Cuts and Jobs Act did away with the loss carrybacks for everybody but farmers. They trimmed the sails on business losses going forward with the excess business loss limitation. That was the Tax Cuts and Jobs Act from 2018 starting January. But CARE says, okay, it's a recession. We have to give more relief to business. We have to allow business losses to be carried back. So the House now, with the latest stimulus legislation, I didn't check the one from last night, but the one before that, they didn't want to allow 18 and 19 to go back. They only really wanted 20. So the CARES Act was pretty beneficial, and we did a lot of NOLs for 18 and 19. So that's what's on the line. So if the IRS comes in and says, wait a second, you are only trading for less than a year, you have a big loss, you're asking for this huge refund, I see you went back to your job and you stopped trading, we don't want to give you TTS. If we pull that rug out from underneath you, you're not going to get that NOL refund from the carryback. There's a lot riding on this for people who are looking to get these benefits. That's why today's webinar is important, because I'm having some reservations. I'm a little concerned about the IRS opening the floodgates to business losses. You know, if you look at the financial news the last few weeks, they've talked about huge business losses and wanting to rein that in. So traders, Main Street traders, can have a $200,000 loss and want to go back and get the taxes they paid on the wages in the previous few years. They're not billionaires. There are small businesses that need these losses and these NOLs. Traders are small businesses. So these are issues for new traders in qualification for trader tax status. So here's what it's all about. Some of the rookie traders, they start off great. They meet the IRS requirements, 4 trades a day, 4 days a week, holding periods under 30 days. In fact, they got 10, 20 trades a day. They're doing great. They look at our eligibility, our golden rules, and they think they're doing pretty good. But we don't know how the IRS or the state tax official is going to consider the COVID pandemic when assessing the TTS. Why would they take issue? Well, consider a furloughed worker who started trading at home full-time in mid-2020. So got COVID spread to their state nationwide, and the company said, all right, you're remote, you're furloughed, you're laid off, you're terminated. There was any one of those, a leave of absence, any one of those categories. Person's at home, maybe doing some remote work, part-time, none at all, looking for something to do, watching CNBC, the market's taking off like a rocket ship. They want to join the fray. So was the trader's intention to create a new business for the long term, So was this someone who said, I've been a software engineer. I don't really want to do that anymore. I think I can make more money trading. It's always been my goal since last year. It wasn't COVID didn't maybe accelerated it, but did not change my long-term planning. And I'm in it for the long term. Or is it just to buy time to make some extra money before returning to your career after the pandemic subsides? Now, time will tell. I worked with two spouses yesterday working for the airlines. It's terrible what's happening with the airline workers. And they had a leave of absence, and they're on the leave of absence until April 2022. So if you're a COVID trader, you started Q2 and you continue well into next year and beyond, I think that's good. But if you're in and out, then we have more of an issue. Now, TTS requires the intention to run a business from catching daily market movements. Doesn't have to be day trades, can be swing trades. It's not for making investments for appreciation. Now, there are people who did well, who got in after the COVID crash in March, who caught the V, who had the guts to do it, and good for them. And maybe they got the appreciation. Those are not traders. I'm talking the traders are day traders, swing traders. But what about the intention issue? Now, besides intention, because by the way, if you don't have the intention, the IRS can say no TTS, even if all your other factors are very strong. They can just say no. Now, longevity is the issue that I've been talking about. If a new trader started trading on June 1st, 2020, but stops or significantly slows down to stop qualifying when returning to work in November, I mean, they're trying to open the economy. Some states are reopening, and hopefully we're not having a scourge of round two. But as the economy reopens and people go back to work, and they may have a lot of pent-up work to do, they may stop or slow down trading. I wonder how the IRS is going to deal with that. Are they going to say it was too short a period of time? So all of a sudden, a tax court case that we dissected and we dealt with years ago and we put on the back burner, it comes front and center again. I'm talking about Chen versus Commissioner. The IRS agent might cite that landmark tax court case, and that's a case where the court denied TTS to Chen. Chen only carried on trading for 3 months. That's what I'm talking about with COVID traders. So let's take a look at Chen versus Commissioner and see what insights we can glean from it and how I feel about it. Now, the tax court denied TTS and 475 to Chen. Comments from a senior IRS official at an industry forum years ago about the Chen tax court case point out that the IRS doesn't respect individual traders as opposed to trading in an S Corp or LLC partnership who are brand new to trading, who enter and exit quickly. Chen only traded for 3 months in Q1 before he lost his money, and then he exited trading. Now, during the trading, he kept his software engineering job during his 3 months of trading. Now, I've said all along since 475 got on the books by Congress in 1997, and I started with my first guide in 1999, which I've updated every year since. I said, you don't have to be a full-time trader. You can be part-time. You can have a job. You just have to hit the golden rules. Think about all the taxpayers in this country that have 1 job, 2, 3 jobs, 1 business, 5 businesses, 10 businesses, other ones with a spouse. There's no rule that you can have 1 job and 1 business. Billionaires could have 1,000 businesses, 1,000 K1s. So Chen had his job, and he traded for 3 months. Now, Chen really soured the tax court, and my problem now is that once the case is in the court on the books, does it set precedent? Does it embolden an IRS agent to just pull it out and say, this is what Chen means, when I might disagree what Chen means? Now, I think what Chen is saying, the case the Chen case, the Chen court, indicates the IRS wants to see more extended time to establish TTS, more than 3 months. Now, some IRS agents, I've seen this happen, they try to intimidate a taxpayer saying, oh, there's a full year requirement. But the law does not require that. Hundreds of thousands of businesses start and fail within 3 months. Think of all the businesses that just started in January of this year, and they had to close their doors when COVID hit. They failed within 3 months. The IRS doesn't challenge them on business status, but that being said, we do respect the fact that the IRS is rightfully more skeptical of traders versus investors, perhaps even more so during the pandemic. And that's my concern. That's the background of today's message is, will it be more skeptical during the pandemic? So let's be prepared to deal with Chen. And I think the way to do it is trading in the prior and subsequent year helps. That case I talked about before where the existing trader for all of 19 lost in Q1, really needs the tax loss insurance of $475. The IRS might say you only traded for 3 months in 2020, but no, this trader took our advice and used TTS for all of 19, even though they may not have needed it very much. They set the table for the 2020 write-off. Now, let's say you're getting in Q4 now, Q3, Q4 this year, and maybe there's only 5,000, 10,000 of expenses on the line, not enough maybe to move the dial for you, and you didn't have 475. So don't just say, oh, I'll skip TTS this year. You want to book it for the Q2, Q3, and Q4. So if you have a big loss next year in Q1 or Q2, you have set the table for a longer period of TTS. So that's why when you qualify, you should use it to set the table. So we often ask clients about their trading activities in the prior subsequent years as we prepare their tax returns for the year. Vigorous subsequent year trading activities and gains add credibility. So what I'm doing for COVID traders this year is you're probably going to be on extension next year. And I'm going to want to see that if you have a lot riding on it and you did exit, can I look at the 2-year time frame? What is it just 3 months in 1 year, or is it 10 months or 12 months when you look at the 2 years combined? And we explain that in the tax return footnotes. We say, don't look at this client for just Q4. They've already traded in Q1 and Q2 of the next year and are doing very well, by the way. So traders can start their trading business in Q4 and continue into the subsequent year. Now, if you get started in November, the window of opportunity is starting to close. I like to see as much of Q4 as possible. So Chen, I'm upset with Chen. He messed up many things in his case. First of all, he did something that you should never do with the IRS. He lied. He lied to the IRS about electing 475 ordinary loss treatment on time. You know, the election procedures are very complicated. There's a 2-step procedure. It's not really well documented by the IRS. There's no tax form involved. And Chen thought he could game the system and lie to the IRS, but they busted him. They said they caught him that he lied, that he didn't have 475. Now, he was trying to deduct hundreds of thousands of dollars, I forget the exact number, with 475. He didn't have too many expenses to deduct with TTS. But he should not have gotten, he was trying to get a huge refund. He wasn't entitled to the huge refund. He should have been stuck with the biggest pitfall for traders, the $3,000 capital loss limitation. So Chen should have had a capital loss limitation. So hopefully you're all staying with me. I know I'm getting into the weeds here. We're going to wrap up this section of it soon, so stick with me here. He should have had the capital loss limitation. He went for the huge, massive 475 loss. They busted him. He had to give it back. He didn't get that. So then he's figured, well, I only have, several $1,000s of expenses with TTS. They're also attacking that. They're saying I only traded for 3 months. You know something? Why should I continue to fight this? I'm probably going to lose, he figured. And he capitulated. So the IRS racked up a win on TTS not being allowed for 3 months, when that's not what Chen was about. Chen was about the lying of the 475. I think I could have won Chen, even though he only traded for 3 months and kept his full-time job. He intended to change careers to trading. He made a substantial investment in time, money, and activity. He hit the golden rule factors. The tax code and case law does not say it has to be a full year, does not have to be a primary means of making a living. I think I could win, Chen, and I think I could win for you guys with 3 months. But don't make life difficult for you. Try to not be Chen. So many businesses don't survive that long. Countless businesses start up and fail in a few short months. Entrepreneurs are experimenting as a business person. So Chen may have won if he was upfront with the IRS and engaged an attorney or a tax expert to represent them in court. He did what's called pro se. He argued it on his own. And the IRS knew that they could beat him up, and they did. So that's a shame when traders go to tax court with real loser cases. We would have told Chen, you lied on 475. We're not arguing that for you in the tax court. And he may not even have gone to tax court, and he might have negotiated with the IRS and gotten the Schedule C expenses. So you got to be smart and reasonable and honest with the IRS. What's at stake? Well, what's at stake is the trader tax benefits, the trader tax status, all the business deductions. So let's say that you took some classes and coaching and mentoring, and you spent $10,000 in April or January, February, and you got scanner software, you bought new computers, you got services, subscriptions, chat rooms, a bunch of expenses. And then you started hitting the numbers on trader tax status soon thereafter. Well, you can go back to capitalize Section 195 startup costs. You can go back 6 months to get at a lot of those costs and then write off the first $5,000 up front, the rest over 15 years. You can go back further for hardware costs. So you're deducting business expenses, startup costs, home office, a huge deduction for traders. So home office, education, startup, organization, margin interest, tangible property for the computers, Section 179, 100% depreciation, amortization, software, self-created automated trading systems, chat rooms, you name it, you can deduct it, stock borrow fees. The typical trader might have 5, 10, 15, 20,000 or more with the home office in terms of deductions. If you're in a decent tax bracket, federal and state, you're saving some nice money with trader tax status. That's just the start. Then you got the 475 tax loss insurance. It converts your capital gains and losses into ordinary gains and losses. Short-term capital gains are the ordinary rate, but short-term capital losses have a 3,000 capital loss limitation, whereas 475 is unlimited ordinary losses. 475 exempts you from the onerous wash sale loss rules. It's a headache for active traders. It causes phantom income, potential excess tax liability. So I always ask traders, do you have a taxable account and do you have any IRA accounts? Oh yeah, I have IRA accounts, Roth IRA, rollover IRA from my old employer 401k. My spouse has an IRA. And because I have 200 in my IRAs and 200 in my taxable, I want as much money as possible to trade. I do mirror trading in both side by side. And my broker doesn't say it's a problem for wash sales, so I'm good to go. No, the broker has a different rule for wash sales, a narrow view. That side-by-side trading could lead to permanent wash sales where you're disenfranchised from hundreds of thousands of dollars of wash sales and never being able to deduct it. 475 is your ticket out of that. It's too late for 475 now. It's past July 15th. You could rush a new entity out. You got to do it fast because it's got to be for most of Q4. The entity can elect 475, ring fence that trading, divorce it from the IRAs, so you still can do the mirror trading. If you don't do the entity, stop the mirror trading with a do not trade list. Otherwise, on wash sales, if you don't have the problem with the IRA, just watch out for wash sales in your taxable accounts going into year end. So you're doing pretty well this year. But you have some losses in December. That people do tax loss selling in December. Tax loss selling is great. Take the loss in December, lower your tax bill for 2020. But then if there's a rally in January, which oftentimes there is, I don't know if it'll be this year, people are getting back into the positions and rallying the market in January. That triggers a wash sale loss. It's within 30 days before or after. So you have to have the patience of not getting back in January. And if you do, knowing it's a timing issue. But that's just a deferral from December to January. Remember, I don't care if you don't have the IRA problem. I don't care if you have wash sales every month of the year, as long as you clean house in December and don't get back into the positions until 30 days later in late January or February, you'll have those wash sales melt away. So you got to deal with wash sales unless you have TTS and 475, which is a huge fix. 475 is very powerful. It's not just about the tax loss insurance. There's the QBI deduction. Make 100,000, deduct 20,000 from your 475 net income. It's a huge benefit, but you get priced out of it if you make too much money. So if you rush out an entity now and make 50,000, you might have a $10,000 deduction going into year end. So do you have TTS now? Do you need 475? Can you benefit from 475? Will an entity help you going into year end? Otherwise, wait on the entity. Maybe you'll start the entity for January 1st. These are the kind of things that people consult with me all day long, every day. That's what I do with new traders, with new COVID traders. Now, if you got health insurance and retirement plan deductions that you want to have as well, then you need the S Corp to deduct the health insurance without any offsetting payroll tax. And if you want to do that solo 401k retirement plan to deduct $63,500 if you're age 50 or older, $57,000 if you're under age 50, then you need the solo 401k with the officer compensation, because your investors don't have self-employment income, they can't do it. And your TTS partnerships and sole proprietors can't do the health insurance and retirement. So if you form a new entity now and get it up and running by mid-October, we can have TTS and expenses in the entity if that's what you've been capitalizing for with these prior startup costs. We can elect 475 to fix the problem with the IRA, not have the year-end issue with wash sales because you're breaking the chain as an individual. And maybe we get a little health insurance deduction, maybe we get a little retirement plan deduction. But if you don't need to rush it, you should not rush it, and then think about it for next year. So again, on the golden rules for TTS, and then we're going to stop to take a look at some questions, and then we'll get into the estimated taxes. You got to have volume of trades, 4 trades a day, counting the open and closing trades separately. So if you have 5 trades and there's 3 buys and 2 sells, that's 5. Scaling in and scaling out counts. Unexecuted trades don't count. When the broker breaks down the lot size, it doesn't count. So we're looking for 4 a day, 15 a week, 60 a month. That's the Pope Court. We're looking for frequency 75%, close to 4 days a week, not 3 days a week, 2 days a week. All the tax court cases disallowed at that. 75% frequency. Don't include your investments, just your trades if your investments are segregated, so it doesn't water down the trader tax status on frequency. Holding period, the Endicott court bright line test, average has to be 31 days. You have some day trading, some swing trading. Again, segregate out the investment so it doesn't water that down, the holding period. Most traders easily get under 31 days unless they're monthly options traders and mix in leaps as well. Hours, 4 hours a day, a lot of traders have that. If you only have an hour a day, it may be because you're doing automated trading and that might not qualify. 25K patent day trader account, 15K otherwise for futures, Forex, cryptocurrency, or active trading in a cash account. Intention to run a business to make a living. You can document that with your, emails to yourself, business plan. Most traders have multiple devices. A lot of them have laptop, desktop, multiple external monitors, iPhone, tablet, or some combination. A lot of traders have a nice home office dedicated. They're doing manual trading with their own ideas. If they use automated trading or scanners, well, the automated trading is self-created. The scanners are maybe just for help, but not necessarily everything they need to do. If you go out and get a canned ATS, automated trading system, where you get a trade copying service and put in very little thought to it, just a half hour a day, and you're basically a passenger in the plane. You got to be a pilot in the cockpit. Go back and take the deep dive on the golden rules on a recent webinar we did and blog post. So the investor gets, and maybe let's take a quick break because I've been talking a lot. We'll look at a few questions. I don't want this to be monotonous. We're just talking nonstop. So let's take a quick look at some questions. 1 second. So hopefully I'll look at some questions for the COVID trader. And let's take a look here. A little more interactive this way. Questions, expand it. All right, I don't see that many questions on the board yet. So what dates are important for someone electing 475 for the next year, 2021? So you missed 475 this year. It's not in your interest. It doesn't justify the extra cost to rush out an entity for the rest of this year. You got health insurance and retirement in your job, or your job year to date, you had the 401k. Your spouse has the health insurance for next year. You're not sure you want an entity. You think that you can navigate around wash sales at year end. You can see what those losses are in December. You can have the patience not to get back in January. You can set up the do not trade list with your IRA. You can make do with wash sale rules for the rest of this year. And next year you plan to elect 475 as an individual trader. You're not going to have capital loss carryover baggage. You're doing pretty well this year. So next year, by April 15th, you'll think about the 475 election. Now, if you have a capital loss carryover and you have gains in Q1 next year, you may hold off on the 475 election because you need capital gains to use up the capital loss carryover. And then maybe you'll set up an entity to get into 475 for Q2. So between the entity and the various dates for the 475, you make the right decision based on those facts. So again, the individual elects 475 for 2021 by April 15th. The existing partnership or S Corp elects it by March 15th. That's next year. All right, next question from Kip K. I'm saying first name, last initial. I don't quite make the TTS golden rules. Well, that means you either do or you don't. I'm the umpire. When you come to me, I call the baseball umpire, I call the balls and strikes the way I see them. If you strike out, you're out. What good is it if I tell you you didn't strike out and then the IRS tells you you did? You want to hear the reality from me, and that's why we have great credibility with the IRS, because we do it with integrity. And that's what clients want. They want great ideas with integrity and trust. All right, so I don't make the TTS, don't quite make it. I have an existing S Corp, maybe for another business. Can that S Corp be trading or the investment business? Or remember, the S Corp and the LLC S Corp or LLC partnership does look better than the individual, because if one thing that came out of the Chen court is that the individual with the huge 475 loss and the Schedule C red flag looks worse than the entity. The entities are set up with a presumption of business purpose. But keep in mind that 29 out of 30 types of hedge funds don't have trader tax status. So there's tremendous, if you're going to buy and sell stocks and futures, the IRS really thinks it's an investment company. The investment company needs to qualify for trader tax status with the exact same golden rules. So I have people come to me once in a while and says, well, listen, I don't really qualify. How about if I just take the treasury capital from my medical practice or my chiropractic practice or my auto dealership and trade that and then deduct my computers and classes and scanner and all that because I have a business that's writing off expenses. So I think that that's trouble. It's harder to claim trader tax status in an existing other business. It should be in its own entity. And it's inappropriate to deduct trading expenses that are investment expenses in a business. Now, some people say, what about in a C Corp? Now, if your C Corp is an auto dealership and you invest the treasury capital in cash equivalents and maybe you buy and sell some dividend stocks and you invest that, that's ancillary to running your auto dealership. It's the cash management function of your business. Well, that's a business expense within reason because it's ancillary to the treasury capital of your C Corp. It's not, but if you set up a C Corp just for trading, the IRS views it really as an investment company and might not allow any deductions at all, no 475, nothing, and not allow any accumulated earnings. So if you have, let's say, an existing consulting business and it went kaput with COVID, and now you say, Bob, I have this solo 401k in there that I've been feeding for years. I have group insurance with my spouse. I'm looking for another business for my existing S Corp or C Corp. Can I just fill it in that new business is trading? Well, that could really confuse the IRS. It could mess you up on reasonable compensation in the S Corp because remember, the underlying income is unearned income. It could mess you up on qualified business income reporting. You could miss the 475 election because that existing entity had to elect it by March 15th, 2020. So it's usually a bad idea. I usually, like 99 out of 100 cases, prefer that you qualify for TTS and that you set up a new entity because for that, it's easy to roll over an existing 401k to the new S Corp. So I don't really like repurposing an existing entity, but it's a little unique. Sometimes it does work. So check with me. It's a customized answer. And this person said they wanted the home office health insurance and from usual consulting work. So I hit it right on the head. That was exactly what the question was about. So great question. As Cynthia Tomaine said to me from Interactive Brokers right before the session, that IBKR loves the Q&A. They like it when I stick around and answer the questions because one person asked a question that I didn't necessarily cover and others could be very interested in the same question. So that was a good one from Kip. So get the questions up from Swapna N, last initial. So for people's confidentiality. If we have two members in an entity and only one member is the active trader, can we make the 475 election? Absolutely, yes. Yes, you can. In fact, that's what normally happens. You have a spousal two-member LLC that is taxed as a partnership or makes an S Corp election. It can have the choice of either. It can elect C Corp too, but you wouldn't want that. One spouse is non-active. We don't say passive because the passive loss activities don't apply to a trading company under the trading rule. The non-active owner gets the business expense deductions with TTS, all those benefits, the startup, the organization costs. They get the 475 election benefit, the tax loss insurance, the QBI deduction. The one thing that the non-active owner doesn't get is business interest. The active trader gets business interest expense. If you happen to have a margin account and you pay a lot of margin interest, you're going to have business interest expense, and your spouse is going to have an investment interest expense, which they can take if they itemize deductions, and they may not, because you might have a standard deduction with the SALT limitation. A lot of people, and the roughly doubled standard deduction, a lot of people use the standard deduction. Plus, the investment interest is only deductible up to the extent of investment income. So when I set up a spousal member partnership or S corp and the spouse is not active, I don't want this client to say, well, I'll make them active. No, you can't make them active. They have to really want to help out. They don't have to be a trader. They can be active in administration. They can be an assistant trader. They can help do research. It's got to be within reason to say that they're active. But if they're non-active, you can mitigate the interest deduction aspect by reducing the ownership percentage for the non-active owner. It could be 99-1, 90-10, 80-20. It's a little more challenging in a community property state where it probably should be more 50-50. That's something I deal with clients when we set up and do our entity formation service. So that was another good question. That's why in a hedge fund with TTS, the active trader can bring the TTS and 475 to the hedge fund level. All right, next question from Rivka S. Why is put assignment not tax advantageous? That's a little outside of what I'm talking about today. When you buy and sell options and have closing trades, those are the ones you count for trader tax status, not assignments or expirations. Those don't count for TTS. Buying and selling equity options, options on ETFs, securities ETFs, those are securities with the wash sale rules or the 475 election if made. The options on the indexes, the stock index futures and futures options and other 1256 contracts have mark-to-market built in, and you don't really want 475. You want to retain the lower 60/40 capital gains rates. Krishna K, and I'm going to go back to the content. I just wanted to get a break for some questions because it spices things up a little bit. Krishna K, can you apply TTS MTM 475 status to one brokerage account and not for another? The answer is yes and no, or no and yes. Technically, no, you don't elect 475 on one account versus the other. And I've seen mistakes where local accountants worked with a trader and I look at their election and it says, on this account, IBKR 52555, we're electing TTS, but not on IBKR account 2223. No, you don't do it that way. Every trading position that you, taxpayer 050 social security number, whatever is associated with your social security number is subject to TTS 475. Now, what you can do, and really what your intention in the question gets to, is can you segregate on a contemporaneous basis investment positions in form and substance that are not trading positions? If you do so, those positions are not subject to 475 and you may not use 475. So here's an example. You used to work for a big tech firm in Silicon Valley. You have a big position in one of those tech names, the FANG names. And you got into trading because you got options, you got interested, you sold, it whet your appetite. And you have some leftover RSUs. And not only that, but you made other investments in FANG stocks, and you have a portfolio of several $1,000,000 of FANG names that you're holding for the long term. And you took our advice and you said, well, it used to all be in one account because you were an investor, you weren't a trader. Everything by default was an investment account. In fact, if you start trading as a COVID trader on April 1st, anything that you held before April 1st by default is an investment position, even if you were experimenting with trading earlier in Q1. It's all investment positions. Now, here's where you can run into some problems. You got your FANG investments. You use portfolio margining to enhance the amount of margin you have to use for trading. So you want to deduct it as a business interest expense because you're using that margin for trading. And you're trading options. Sometimes you're writing covered calls. You're managing risk on around the FANG investments with options. There are a couple of problems that pop up here. Are they sufficiently segregated as investment positions? That's number one, because otherwise you might have to look at their holding period and it could water that down and you'd lose TTS. If you have 475 as an individual, I think there's a potential problem. The IRS can play havoc. You don't want the IRS grabbing at your FANG stocks, saying you have to mark them to market at year end, because then you're not going to get, as ordinary income, you're not going to get a long-term capital gain, or you're not going to get deferral, and that's what you want. And you don't want the IRS saying this $500,000 trading loss in options that you built up around those FANG stocks, trading the options, kicked out of 475 ordinary loss. If this is your case, I want you to choose between portfolio margining on the individual level or ring fencing your trading into an entity, putting the trading into an entity, LLC, S Corp, or partnership, using 475 in the entity. It's a separate divorced taxpayer from you individually, and then doing your individually investments on the individual level. That's one reason why we want a new entity, and that's something I covered during the consultation. So there are nuances, and I'm glad that question brought it up. So how you have the accounts labeled, if it's a wife account and you're trading it as a husband, wife can't have trader tax status. It's got to be a joint account. So there are some technicalities involved. So you want to think this out carefully before you jump into decision making. All right, we got some great questions building up. We'll stop. We'll get to Louise next at 12:39. Let's get back to the content. We got some great other questions. I'll save those for later. So stick with me, folks. We got some other good content here. So let's collapse the questions, minimize the window, and play from the current slide. All right, so what happens if you don't have TTS? You took a shot at it. You're a Chen trader. You're a COVID trader. You didn't cut the mustard, or you cut the mustard for a certain period of time, and now you're back to being an investor. Is that the end of the world? No, it's not the end of the world. Here's what you get. Here's what you don't get. So traders who don't qualify, they can only deduct the margin interest. I explained that already to that answer the question, if they itemize. Now, we make a case for borrow fees too, but that's a little confusing. Now, maybe you'll qualify for TTS in 2021. Maybe you're on, you're off, you don't feel comfortable with it for this year. Your local accountant doesn't, we don't. But you're thinking about it for next year. Now, if you qualify in January, you can go back 6 months to capitalize startup costs. So maybe that scanner software, the trading course you took it after July 1st, and you can capitalize it as Section 195 right off the first $5,000, the rest over 15 years. Go back even further, capitalize some of the computer equipment at the fair market value, not the showroom price or the purchase price, and the undepreciated amount. So there's a look back period. Without TTS and a 475 election, you're going to have to watch out for wash sales. We went over that already. If you got the problem with the IRA, stop that with the do not trade list. Trade the FANG stocks. Don't invest in the FANG stocks in the IRA. Invest in the biotechs. Do something else, mutual funds, cash, whatever you want to do. Avoid that permanent wash sale loss problem. That's sort of like a speed limit sign on the highway that's blocked by trees that most accountants and taxpayers don't see, but we see it. If you want to do things right, you need to deal with that problem. Read our wash sale content to learn more about it. Otherwise, just avoid the wash sales in the taxable account at year end. Do the tax loss selling. Show the patience not to jump back in. If you want to jump back in, then say, okay, I'll eat the wash sale. I'll have a little more taxable income in 2020, and I'll defer the loss to 2021. Not the end of the world. So if you know that you have, if you say, you're talking to me in the consult and it comes out, the facts come out that, hey, you lost your job in COVID, but your spouse still has their job with health insurance for the family, or you have another business with self-employment income to deduct health insurance, you don't need to have the S Corp just for health insurance. And if you're on COBRA, that's not deductible because it's not self-employed health insurance, it's ex-employer provided. So maybe you don't need to rush into a TTS S Corp. So maybe you're going to trade futures and not need 475. Futures are fantastic, like the stock index, the E-minis, the micro E-minis. Those stock index futures, you're playing the stock markets or you're trading the stock markets. It's nothing about it is playing. But it's 1256 contracts, summary reporting, mark to market. So there's no unrealized, you don't have to do tax loss selling. It's already mark to market at year end. There's no deferral. The 60-40 capital gains rates apply 60% of the long-term capital gain. In the lowest two brackets, that's zero. In the middle brackets, it's 15% flat rate. In the top bracket, it's 20% flat rate versus the ordinary rates, which go from 10 to 37%. Do the math, come to the 1256 page in our tax center. It gives you a table on the math. It's almost 1/3 off the rates. If you make an extra $100,000, you might save $10,000 or $12,000 in taxes just from trading 1256. Now, if you don't have TTS and you don't want to trade futures and you just want to trade securities, maybe you trade your retirement accounts, growing them tax-free until retirement in traditional accounts and permanently tax-free with the Roth IRA. So there are other things that you can do if you don't have trader tax status. Now, some of you, when you were looking to get started as a COVID trader, you said, well, I'm impacted by COVID. I lost my job. I got sick. I'm eligible to make one of these CARES Act withdrawals. An early withdrawal, you're under age 59 and a half. Normally, if you take money out of your IRA, there's a 10% penalty and then it's taxable income. But with this special rule with the CARES Act, you could take, if you're eligible, click that link at the bottom to really see if you make sure you're eligible. If you took it out before COVID, you're not eligible. So you had to meet the eligibility requirements, which are trickier than people might have originally thought. You could take that 100K, pay it back over 3 years, roll it over so it's not taxable at all. There is no penalty, or pay taxes on it over 3 years. I don't know if that was a wise thing to do, but a lot of people did it. They started trading and some of them made a fortune. Some of them may have lost it. It's always a careful decision to make with your family, especially your spouse, when it comes to using retirement funds for other than retirement income. That's a nest egg, an important nest egg. But yet a lot of traders did it and it worked out for them. Now, bottom line is, some of you new traders are confident to continue. You're doing well. Even now with the market volatility up and down, you're doing well. Traders can make trades that are bearish or bullish. There are instruments to do that. There's volatility instruments, which can be highly volatile and dangerous or lucrative as well. So on a daily basis, that's what I'm doing, consulting on TTS 475 and entities. It's incredible how many traders from all walks of life, I'm talking about from entertainment industry people in Los Angeles, from oil patch people in Texas, from very successful software engineers in Silicon Valley who are no longer happy to make $150,000, $200,000, $300,000 a year working for a FANG company. They want to make $1 million a year trading. Policemen, veterans, Army people, healthcare professionals, financial professionals from all walks of life, from all ages, as I pointed out before, college kids, people. One guy was a nuclear scientist getting his PhD from MIT, one of the brightest minds that we need in America, but may not want to do that job because he can make $1 million. He's made $1 million already this year. I've never seen anything like it, and I've been doing this a long time. I don't want to say how long time, but probably like some of the industry people that lead some of these famous old brokerage firms. I go back that far. I've seen the ups and downs of the market. I've seen the best traders make and lose, and that's why I like 475 for the tax loss insurance. Some of you people will continue. Others might get a big loss and stop. And if you get that big loss, you want to stop with 475. You don't want to stop with a capital loss carryover and not have much money to make back those losses and get stuck $3,000 a year for many years to come. Now, during my tax consultations, many clients tell me they don't want to return to their jobs. I tell them like their parents probably told them, hey, you're an engineer, you're a doctor, you're a lawyer, you're an opera singer, you're a TV director. That's a great thing to still do and to still not to throw away. So if called back, maybe you can still carry on trader. Maybe you'll still be remote. People can still do both of these activities. So make the right decision. And it's a personal decision. You don't come to me for that type of advice. I'm a tax advisor. But some clients do appreciate my comments that I might make if they invite me to do so. So you've done great. You had a job last year and you paid your taxes, you had your withholding, and this year you hit the ball out of the park. You've done great. When do you have to pay taxes to the IRS? Traders owe quarterly estimated taxes. Many traders have substantial trading gains for 2020 year to date, and they might owe 2020 estimated taxes paid to the IRS quarterly. If you didn't know that, you better know it now. Unlike wages, taxes aren't withheld from trading gains. If you made $1 million, how much do you owe in estimated taxes? Others can wait on tax payments until April 15th, 2021, when they file their 2020 tax return or extension. I want you to focus now on Q4 estimated tax payments. Now, the first 2 quarters of estimated taxes, Q1 and Q2, they were due July 15th, the postponed date with COVID postponement. So normally Q1 is April 15th. So when you go to file an extension, normally you overpay it. You include an overpayment credit to cover Q1 and maybe Q2. That's the strategy that we normally do. So Q1 and Q2, that was due July 15th. And what a lot of traders did is they went on extension July 15th. Now their returns due October 15th, 2020. And they overpaid the extension by quite a bit to give them plenty of room for the 019 return and to have an overpayment credit to apply to Q1 and Q2. If they were doing well as a Q3, some of them made Q3 payments on September 15th. Now, a lot of traders, they're not that happy to pay estimated taxes because why pay a boatload of money for Q1 and Q2 if you're going to turn around and lose all that money in Q3 and Q4. Traders want transparency for the year, and you got that with Q4 because Q4 is due January 15th. In the old days, you'd pay the state on 12/31 for a deduction, but now with the SALT limitation, it probably doesn't matter. So you wait until January 15th when you really can run your trade log or look at your brokerage reports and see, hey, I made $500,000, I made $1 million. You have the transparency, and now you want to decide about the Q4 estimate. So many new traders, they didn't submit estimated payments for the first 3 quarters. They didn't know if it was too good to be true. They were waiting to see what Q4 brings. With full transparency at year end, traders can make the Q4 payments with more clarity. Now, what happens if you owe money for Q1, Q2, Q3, and you didn't pay it? Because the IRS, when they calculate the penalty, we'll talk about the Form 2210 in a second. They're going to say, here's how much you made in Q1, Q2, Q3, Q4. You got penalties throughout the year. The rate was 5% for underestimated payments for Q1, Q2. It was changed to 3% for Q3. Maybe it will be 3% for Q4. Sometimes you think, hey, that's pretty low. 5% was pretty high when you think of what the market rate of what the AFR rates for interest were. So traders say, hey, Bob, that's like a margin loan. That's not too bad. I mean, IBKR I know has good margin rates, but other brokers are higher. I'm not here to sell IBKR, I'm just pointing that out, but that would be inappropriate for me to do anyway. But the point is that for some traders, they're desperate for capital. That's why they're day trading. They don't want to tie up capital. They want their money working for them daily, weekly, catching the swings. That extra $100,000 of capital that they would otherwise pay the IRS, they think they can make a lot more than 5%. So they would rather have this, in this case, a non-deductible type of margin loan. Margin loans for a TTS trader are a business expense. This is not a business expense. It's not deductible, the underestimated tax penalty. Now, if you make $1 million this year, do you have to pay that quarterly every quarter? Probably not. You're probably going to be able to use the safe harbor exception. The IRS says, hey, wait a second. If you didn't make too much money last year and you hit the ball out of the park this year, the baseball analogy again, you made a lot of money, more money this year, your income skyrocketed. We don't expect you to have paid estimated taxes for that. We just want you to cover what you paid us last year. So that this is the safe harbor exception. The safe harbor rule for paying estimated taxes says there's no 5% penalty, 3% penalty, underestimated tax penalty for underpayment, providing the payment you make equals 90% of the current year. So last year you made a fortune, you're not using the safe harbor. This year, yeah, you do have to pay 90% of what you owe throughout the year. That's not the safe harbor. The safe harbor is this second part, or 100% of the previous year's amount, whichever is lower. So last year, you had a job, you made $200, you paid your taxes. Or let's say last year you made $100,000 in your job, you paid your taxes. This year you made $500,000 trading. You just have to cover what you pay. You look at your W-2 for last year, you look at your tax return, it said at the bottom, tax liability, it said my tax liability was $20,000 for argument's sake. That's all you have to pay as an estimate for this year, even if you made $1 million, because you're covering the prior year. Now, if your prior year adjusted gross income, AGI, exceeded $150,000 married or single, or $75,000 married filing separate, then the safe harbor rate rises to 110%. So let's look at an example. Suppose your 2019 tax liability was $40,000. You look at your 2019 tax return, the last line of tax liability, not tax balance due after credits and payments, but the tax liability, including SE tax. Your bottom line tax liability was $40,000. You also look at the AGI, adjusted gross income line. That was $150,000. Well, that was over $150,000. So that tells you have to cover 110% of the prior year. So you're going to assume that your 2020 taxes will be approximately $100,000. You did some rough calculations with a tax calculator, and it says you're going to owe $100,000 for 2020. And you haven't made one payment for Q1, Q2, Q3. You don't have an overpayment credit from 2018. You had a balance due for 2018. So you got no credit going into 2020, and you figure you're going to owe $100,000. How much do you pay on January 15th? How much do you pay on April 15th? Do you owe the whole 100 on January 15th? Or can the whole thing wait to April 15th? The answer is you owe some by January 15th, and you owe the balance by April 15th. So using the safe harbor rule, you can spread out the payment, submitting $44,000, 110% of the $40,000 liability from the prior year to cover the prior year. You're going to cover 110% by January 15th. That's what you pay for Q4. And the balance of $56,000, which is the balance of the $100,000, you're going to pay on April 15th. This is a nice option to consider instead of sending the whole $90,000, which is 90% of 100. So you get to pay either $44,000 or $90,000, the lower of, and you choose the $44,000. That's what you probably want to do. Now, there's a risk. You should consider setting aside that $56,000, which you know you're going to owe on April 15th, rather than rolling the dice on it in the markets for Q1. Now, we've seen this happen so many times. Every time there's a tech wreck type of situation, whether it's a crypto crash, a tech wreck, or whatever, it's been in every recession or every market top. The people, they owe a lot of money for 1 year, risk it in the markets the next year, it all disappears. They don't have the money to pay the IRS, and they get into trouble. And then they need a payment plan. Then they hope they can do an NOL carryback. There are no NOL carrybacks next year. The NOL law was just loosened for this year, 19 and 18, not for next year. So you can't do that carryback to bail you out. So be careful with the tax monies. So in the above example, the trader should calculate the underestimated payment of estimated tax penalties for Q1, Q2, and Q3. Yes, you could pay the $44,000 on January 15th, but you still have a payment penalty for Q1, Q2, and Q3 because you were supposed to be paying it throughout the year. Now, you want to consider using the Form 2210 annualized income installment method if the trader generated most of his trading gains later in the year. For example, Q1, you were flat. You didn't even trade. Q2, you were flat. You just started trading. Q3, you were flat. You had a loss. You didn't owe estimated taxes for those quarters. You made that whole huge amount of money all in Q4. So you can mitigate the penalty using the annualized method. If the reverse is true and you front loaded the income up front during the year, then you probably don't want to use the annualized installment method. Now, because the default method will annualize the income to each quarter respectively. So you want to delve into the 2210 factors. Now, estimated tax payments are based on the current year, or the safe harbor exception. So if your 2019 income tax liability is significantly higher than your 2020 liability, consider covering 90% of the current year with the estimated taxes. So, for example, Last year, you worked on Wall Street, you got a huge bonus, you made $1 million. Yet your tax liability is really high. You left your job in January, you traded this year, you made a fraction of what you made last year. You're obviously not going to use the safe harbor. So you had a great job last year, you had a big liability. This year, you and your spouse lost your jobs with COVID. You made some money trading, but not a lot. You're not going to use the safe harbor. You're going to base it on 90% of the current year. And you're not done. You got to look at the state rules too. The state rules are similar, but a little different. So you got to cover your state as well and learn more about the estimated tax rules on our website, in our guide, and on the IRS website. Now, here's a nice nifty trick that you can do. Let's say that you have a job and you're also trading, or your spouse has a job and you're trading. Employees, or you have your own trading S Corp and you're going to do a big payroll in December to unlock the solo 401k retirement plan. You're going to pay yourself $150 and you're going to do the $63,500 solo 401k and the health insurance reimbursement. You got wage withholding that's happening. Well, here's a beautiful solution. Employees have another way to avoid underpayment of estimated tax penalties on non-wage income. They can ask their employers, if you have your own trading S Corp, you ask yourself, you're the employer, to increase their wage tax withholding in November and December. You can do it this month too, October. Now, the IRS is going to treat that withholding as being made equally throughout the year. So let's say you owe that $44,000 for Q4 on January 15th, and you owed it equally throughout the year, and you're going to have a penalty for Q1, Q2, and Q3. Well, maybe you make the Q4 1/4 of the payment through estimated taxes, but Q1, Q2, and Q3, you pay by increasing your wage withholding, and then there's no underestimated tax penalty. All right, let's get to the rest of the questions. So get your questions on the board, folks. And let's go over to the website to bring it as a backdrop. And let's bring up, so get the questions on the board and just give me 30 seconds. I'll be right back. So we're taking a 30-second break while you get your questions on the board.
And while we take the break, I thought I would remind everyone there is a questions panel that's located on the right-hand side of your screen. If you simply double-click that panel, you can type any questions that you might have for Robert at this point. So get your questions in. And while we wait for Robert, I also want to mention here that today's session has been recorded, and I will be generating follow-up messages that will go out to each of you later on this afternoon. I know Robert's covering quite a bit of information here with you today, and if you do want to come back and review any of the concepts, simply watch your inbox later on this afternoon for a direct link to today's recording. By the way, if you'd like a copy of today's notes or the slides that have been used today, notice there's also a handouts pane where you can download the information or download today's slides directly before you do exit today's session. Well, I hear Robert in the background. Are you back, Robert?
Yes, thank you, Cynthia. Like a TV break. All right, so we stopped with the question from Louis E. Would I need to elect 475 every year or just keep it on file? The latter. You make the election once in a proper manner and you use it. Otherwise, it's null and void and you have to make it again in a year you use it. So let's say you made it for 2020, before July 15th, you have TTS and you use it and you perfect it with the 3115. Now you have 475. It stays with you until and unless you revoke it in a similar process to electing it in just reverse. You file a revocation election. You would only want to do that if you had a big capital loss carryover that you still wanted to get back to using up or something like that. Otherwise, if you don't qualify for TTS in a given year, so you qualify this year, you use it, next year you fall short, you don't qualify. You may not use 475 unless you qualify. It becomes suspended. But the next year in 2022, you re-qualify for TTS, 475 snaps back into use because it was suspended if you didn't revoke it. So the answer is you elect it once and it stays with you until and unless revoked. And you can only use it on TTS positions. So if you don't have TTS and everything's an investment, you can't use it. James K. If you set up an entity and specify a year end other than 12/31, well, that's pretty hard to do because most past due entities are owned by individuals, and that it's hard to argue for another type of year end. So I'd rather not answer that question. That's outside of the scope of our discussion. So Rick M. Can you please discuss U.S. full-time traders that travel, spend considerable time abroad? Are there any potential problems to consider? Trading is a remote job. It's one of the original remote jobs. It's a wonderful thing. You do it from home. You do it from a second home. You do it from while on vacation. You do it while you travel around Asia. You do it moving to Puerto Rico, where trading is mobile. Traders are mobile. Now, with so much displacement caused by wildfires, tax policy, hurricanes, whatever you want to chalk it up to, traders are on the move. They don't have to pay the highest taxes to the highest tax states. They can move to no tax states if that's part of their lifestyle decision and family decision. So yes, you can trader tax status goes with you. Usually want the entity formed where you are. So if you're going offshore, abroad, which this question's about, there's something called a foreign earned income exclusion, where you exclude up to about 107,000 it raises each year of foreign earned income. You work for Apple, you go abroad, you get wages of 200, your 107,000 is a deduction from adjusted gross income because it's foreign earned income. And you really want that if you move to a place that's not taxing you locally, because otherwise you could get a foreign tax credit. So you want the foreign earned income exclusion. Problem: trading income is not earned income, so it can't be foreign earned income. Solution: if you're going to set up a TTS S Corp in Delaware to unlock the health insurance and retirement plan deduction through S Corp wages, presto, those S Corp wages are foreign earned income, so you can get that in the housing allowance. So it can be arranged, but you need bona fide residence abroad with a physical presence test. It's got to basically be 330 out of 365 days. So there are requirements. If you move around as a trader nomad, you might not get out of California domicile because they want to see you land somewhere, not go temporary and transitory. And some of this foreign earned income exclusion requires bona fide residence too. So you want to, there's more planning to do, but there is a yellow brick road of benefits to get if you follow the right approach. Next question from David, and I cover that in my guide, the Green's 2020 Trader Tax Guide. There's an international chapter. Chapter 1 is TTS, Chapter 2 is 475, Chapter 5 business expenses, Chapter 7 entities, Chapter 8 retirement plans, Chapter 9 tax planning. All the stuff we discussed is in the guide. Get that guide. It's very useful. David H. Did you say that hedge funds cannot deduct business expenses because they're not classified, because they're not TTS? Most hedge funds don't have trader tax status, or if they do, they have a hybrid. It doesn't relate to most of their expenses, and they don't get business deductions, but their management companies get business deductions, and they use carried interest profit allocation so they don't have to deduct performance compensation, and the management company pays most expenses. But yes, a lot of hedge funds are investment companies and don't have business expense deductions, and they don't want to pay investment fees, so they do carried interest profit allocation. On our website, go to the Trader Tax Center and click on Investment Management to read all about that. So let me just show you quickly. Whenever there's a question, you go over to the website, you go to the tax center, and you would go down to investment management and read about the difference between the separately managed accounts and hedge funds and trader tax status. For international, you go to the international tax matters page and read about that. For tax planning, you go to the tax planning page. For entity solutions, entity or retirement. For wash sales, you'd go to tax treatment and go over to wash sales, or you'd go over to 1256 contracts. So first go to our tax center, go to the blog, and look at the categories for the blog, and go to the events. Well, every webinar I've done with IB going back for years with the YouTube recordings, or they also have it on their site, are all on the events page. There's tons of stuff to go back and watch. People do their homework before they do a consultation with me, so they really boil down their questions, and they're educated, and we really can spend the time in a very useful, productive, valuable manner. Chris M. Is it worth to go through all these steps if a person has few deductible expenses and health insurance and 401k in their regular employment? Maybe not. That's a great point, Chris. If you have $1,000 of expenses, you don't really need to push the envelope on TTS. If you don't need 475 tax loss insurance because you're trading futures with 60/40, you don't even want 475. You don't need a health insurance deduction or a retirement plan because you have those through your spouse or another job. Then yes, you may not need TTS. Now, if you have a huge loss in futures, you may want a temporary 475 election that you can revoke, but TTS may not be for you and you may not need to push the envelope. So that's a good point, Chris. Some people have multiple questions. I'm going to try to go to original questions so I get everybody in. Swamp had another question. Can collecting premium? Yeah, trading options can be for 475. If you use the trade log software, it won't really dissect the various option strategies. We'll just anything that's substantially identical on closing trades. So Apple options are substantially identical with Apple stock. So whether it's covered call or puts calls, credit spreads, it's going to pick up the wash sales accordingly. James K. Will you differentiate the difference between 988 trader, that's Forex, and 1256 for spot Forex? Okay, so you're trading spot Forex in the interbank market. It's ordinary gain or loss, ordinary income, ordinary losses. You have a big loss, you have wages, you write the whole thing off. There's no capital loss limitation. You don't have any other income to offset. You don't have TTS. It's a wasted loss. Capital loss carryover would be better. If you trade, you can make a capital gains election in your own books and records on a contemporaneous basis, on a good to cancel basis for the whole year, or tomorrow through year end, or today through rest of today through year end. And instead of being ordinary income, gain or loss, ordinary income, ordinary loss, it's capital gain or loss. Why do you want that? You have a large capital loss carryover from years past. You want to use it up. You want capital gains. If you trade the major pairs that also trade on the CME as a currency future, that's what major means. It trades on the CME as a currency future, but you traded in the interbank market, and you have made the capital gains election, then you can qualify to use 1256G for foreign currency contracts to get the lower 60/40 capital gains rates. You want 1256 rates, lower rates. You make the capital gains election. It's got to be on true spot market. It's got to be a broker that trades in the spot market, not just cleaning their own books. You got to read the content on our website about it. Go to the blog. Go to the category Forex, read all the content on Forex and in a guide as well. It would cover Forex fully in the guide. Arturo L. I have TTS and S Corp that I started February 2020. Good. I was trading futures for all of February when I had to stop for a couple of weeks in March due to the market volatility and the shock and the COVID, and that's okay. You can stop, you can have a vacation, you can have a retooling. You just can't have multiple sporadic lapses. Does that qualify? Well, if you started February 2020, had a sticker shock, COVID shock break, which is totally understandable, but then back at it through year end into next year, I think you're good to go. And you can do the wages based on the futures trading income. Doesn't have to be from securities income. So you're okay. David H. What happens if you make quarterly payments late? Well, they're treated as being made for the next quarter. So, I mean, there are some people that send a check on September 16th. They may have marked it, they held it a day and the check was dated the day before, and the IRS may give a little leeway. That may not happen. But if it's now, if you're trying to pay Q4, that was September 15th, it's too late. I don't do the tax compliance nuances day in and day out anymore. My partners do, and the rest of our CPAs do. Swamna has a lot of questions. I think you should get back to me for a consult. JB, does the IRS keep track of your data 475 election? No, it's a problem. When you make the election, let's say you attach it to your return, or you attach it to your extension, you filed certified return receipt, which may not have been processed during COVID, or you faxed it, they put on file the extension, the return. They may not make a note of the 475, or they might, you don't know. When you go to file your 3115, we file a perjury statement that says I filed the election on time, which really helps. And they keep track of the 3115. This brings up to mind that I was contacted by Bloomberg Tax a couple of days ago. There is going to be a proposed rulemaking about the election procedure that might come out before year end that we're going to tackle with Bloomberg Tax when it comes out. So we'll stay on top of that. There's no doubt that the election protocol is overly complicated. There should be a form. It should be a one form filing. It's a two-step process. It's a statement. It's very confusing. There was a COVID postponement. It definitely could stand to be improved. But don't cheat and try to game the system. We would never go along with that. Remember Chen. Chen tried to cheat. He got busted. Venkat C. After setting up an LLC for TTS, how does it affect the estimated taxes? It doesn't. It's a pass-through entity. There is a little peculiar way that it impacts the estimated taxes. When you have a pass-through entity and get K1s, it's treated as being equally made throughout each quarter because it's a pass-through entity. So if you front load your income, that helps. If you backload the income, it hurts. So it does affect the annualized income installment method. That's last how I looked at it years ago. Again, I don't do the compliance work every day anymore like my partners do. That's all we do. That's our core business, is the compliance, but I spend my days with the consultations. So if you may want to ask one of my partners that question. And sometimes my partners are on these webinars. I know Cynthia likes having one. Darren is as well. And Darren answers a lot of questions on the board, but he's just really focused on the 10/15 deadline today, because that's the deadline for filing 2019 returns. Don't come to us asking us to prepare your 2019 tax return now. It's too late. If you're prepared to file late, maybe you don't owe any penalties, we can help you after October 15th. And that's when we'll field questions for new client evaluations for 2020 tax planning after October 15th. So I'm wrapping up soon, Cynthia. We got a couple more questions. I know you'd like me to get to them. Mikas R. I am a non-US person, potential trader nomad. So you might be a non-resident alien, don't spend 183 days a year in the US, so you don't pay capital gains taxes in the US. We had a really nice webinar with Interactive Brokers on the non-resident. Check that, search that on the events page. Rav A, if you elected 475 before July 15, but don't qualify for TTS, what happens? That's a great point. TTS is undergraduate school. You assess and claim it yourself, but you got to apply to grad school 475 on time by July 15th. You did so thinking that you might qualify, but maybe as a COVID trader, you realize you don't qualify. So your election to grad school is null and void, and you'll have to re-elect for next year. Or you racked up some big capital losses in Q1, Q2. You do qualify for TTS in Q3 and Q4. So the 475 election snaps into place for Q3 and Q4. But then what about those big losses you had in capital losses you had in Q1 and Q2? It could work out against you. So you got to sort that out with me. It can have, that's why I didn't want people to make the blank election for July 15th if they didn't have TTS yet, because of that potential problem that I just said. I see some nice comments on the board. Thank you very much. Here's the last question from Rav A. If you had capital losses before 2020, a big loss in 2020, and elected 475 with TTS, what about the losses from before? You want, so in the 5-year NOL carryback. So that's exactly what happened. So you came to me before July 15. We assessed your TTS. Look good. You got TTS for 2020. Then I said, what is your, this is exactly what I do in a consult. So I'm glad we're finishing with this question. What is your year-to-date capital gain or loss? Oh, I'm down 200. You have a cap. What is your capital loss carryover from the year before? Do you have one? Yeah, it was 300. So you carried over 300 from 2019 into 2020 as a capital loss carryover. You were down another 200 year to date when you were talking to me going into the July 15th deadline. You were talking to me in early July. What do? Well, you elect 475 so that the current year to date 200K loss is ordinary, and that if you stop, you'll get an NOL carryback. You don't want to add to your capital loss carryover hole of 300. You're already in a ditch of 300 going into 2020. You don't want to now go down 500 by adding 200 to it. You want, again, a capital gains ladder to climb out of the ditch, a 475 emergency election, which you made, so that you had an ordinary loss, which you could use against your wages or have an NOL carryback. And then the strategy was a do-over entity to form an entity to get back to capital gains to use up the capital loss carryover. Or if there were losses in the first 75 days, to elect 475. I'm probably losing some of you here. This person who asked the question did everything right, can get best of both worlds. You're working to use up your capital loss carryover. You're working to use your current year loss with TTS and 475, so it's ordinary and you get a refund right away. And then you have a strategy to use up your capital loss carryover with a new entity. So you have the best of both worlds, using up the capital loss carryover and using the current year loss as ordinary. That's what you seek to get out of a consultation with me, is how to make the best of your situation. So thank you everybody for coming. There were great questions on the board today. So come over to the website. Let me close the question screen. Click on contact us, fill out the form, put in your message, email us, give us a call, which will pretty much transcribe your message to our team. Get a consult with me. That's what I do all day, every day. Get on my calendar to figure out what's best for you to going into year end for next year. Maybe we'll set up, very little time left for an entity this year. If you really rush it, it's doable. I've been doing a lot of those, and you have to execute quick. Otherwise, we can set up your single member LLC in December, get the accounts open, but the entity starts Jan 1 for a clean transition to the entity for next year. You might need year-end planning, Q4 payment. Do you have TTS? Should you pay for your expenses now or next year? What are you going to do? IRA problem. Do the consults with us now. Our whole tax team will be available to help you as well after October 15th. Thank you, everyone. Thank you, Interactive Brokers. Thank you, Cynthia. Back to you.
Okay, well, Robert, thank you. A terrific session today. We all appreciate the information and your insights. Now, as a reminder, we've been recording today's event, and you'll all get a direct link to today's recorded playback later on this afternoon, so do watch your inbox. By the way, and thank you, Robert, for mentioning our archived events. We've got quite a few events that Robert has done over the last several years that you can access using the link that I'll provide in the follow-up messages too. Simply go in. You can also find these on the Interactive Broker website under the Education menu. There's a webinar section where you can filter by presenter, Robert Green, and view any of his previous presentations. So with that, we are going to conclude our session today. Thank you all very much for your participation. You can exit using the X in the upper right-hand corner. Have a great rest of your day, all, and thanks one more time to Robert Green. Have a great weekend, everyone. Thank you.